everyone, it's Evan here from the Trade Risk on Tuesday, April 3rd, here with a midweek market recap video. We're going to cover all the major markets and the current market environment. Thanks so much for jumping in and watching this video. Every Tuesday and Friday, we do the market recap videos. This is a midweek edition, a little bit shorter. Don't go over the sector analysis, but hopefully we hit on all of the major markets and averages here to give you some insight and to equip you with some ideas heading into the end of the week. So let's jump into charts now with the S&P 500. This is the cash settled market, and we're looking at a weekly chart. So that means every bar that you see on this chart represents exactly 1 week worth of trading. And we are looking at the cash settled S&P 500 market. So first things first, let's take a look at this week's action. You can see we are down on the week. We're down 1.22%, but we're well off of the lows of this week. It is only Tuesday, so it is early, but you can see here, even in early days of trading this week, we got down to 25.53 in the S&P 500. We closed around 26.08, so we're over 50 handles above the lows of this session. And most importantly, is sort of where this bar is occurring and where this bounce is occurring as well. So what we saw this week is, even though we did get all the way down to this 25.55 level, that undercut, that took out last week's lows, that took out the prior 2 weeks lows. So last week we had a low of about 25.93, prior week 25.85. We cut through all of that and really sort of looked over this scary ledge here. As if you zoom out here, you can see we got the trend line that extends from the 2016 lows that meets price right around this 2600 level, 2590 level. And again, it's not super precise. I know everybody's going to draw this in a slightly different fashion. I don't want to get hung up on precisely where that trend line is. I think it's just here as a general gauge to show the slope of this recent multi-year move here in this bull market. But again, I think it is coming at this confluence of horizontal support in here, the prior 2 week lows, a lot of sort of emotional trading back here from the early February decline, this knee-jerk sort of pullback here in the market in early February. When we look at the daily chart, you can see has some influence right around that 2580 level as well. And we briefly broke below all of that, but we did reverse and are heading higher. Looking ahead to the end of the week, if you want to, start thinking about it, and I encourage you to start thinking about this bigger picture in the back of your mind here, given the fact it is at an interesting, very high stakes point. We want to think about how this weekly bar is going to be closing, and if you are bullish on this market, you want to see us closing really ideally above 2600, but 2580, 2590, that general area, you want to see us close above that for a little bit more confidence that a low, a tradable low, and maybe an intermediate low is potentially going to get put in here. So something to think about heading into the end of the week. If we do lose it, if we do come crashing back down below 2590, 2580, then, all bets are off. I think this market could really get, have some fast unwind here. I'm not saying that has to happen. I'm saying if we start losing 2580, there's not a whole lot. It's kind of a big air pocket in here. There's room to really kind of capitulate and move lower if we start breaking this area here. So it's something to be very aware of and mindful of, especially if you're putting on longs and shorts in this general area. The other sort of bearish note here is we got the 8 and 20 period EMA here on the chart, light blue line and the yellow line. We're starting to get a bearish crossover on the 8 and 20, and that is above price. Price is below the 8 and 20, which is going to be bearishly aligned. That is not a good alignment, particularly on a bigger time frame. That's not something that suggests that you have the wind at your back if you are a bull. So that is the big picture there. Now let's look at the daily chart. And the daily chart, I think, is interesting, and especially, again, the way this trend line kind of comes into play here from 2016 and this 2585 level, how it kind of moves back here and shows its significance. And if we look at Monday's session, again, I think this is a very important day here where we did undercut and make a move all the way down to 2553. And look, we bounced exactly up and closed right above the lowest daily close of the year, which was back here on the 8th of February. We closed at 25.81 back on February 8th. And if we look at yesterday's close on Monday, it was 25.81.88. So right above it, we managed to kind of push back up and recover the intraday lows, and now here on Tuesday we've made some more follow-through progress and actually reclaimed some of these lows here from Wednesday, Tuesday, and even Monday of last week. So from a real tactical posture in this market, I think you do have to appreciate the bounce here and respect the fact that it is coming at a very significant level where there is some higher anxiety and a bigger, an elevated VIX right now, and there is some protection out there because I think people do realize that, hey, we are sort of looking over the ledge here at a potentially even, 15 to 20% correction, because that really opens the door when you start breaking through this level. And we did, in fact, get that bounce this today, we're a little bit into the close here on Monday, and then again follow through today here on Tuesday. So I think you need to respect that. And I think if you're tactical, if you're short term, if you're really looking for some tight, tight reward to risk levels to allocate capital to, this seems like a reasonable spot to have some calculated long exposure on. But I say that with, needing to know where the exit is and making sure you're position sizing accordingly, right? And everybody's time frame and strategies are different. So that's why I don't, generally speaking, like to give, buy or sell calls, because I think it gets lost when everybody's viewing this with some different time frames. But I think, again, you could think of it as a tier one if you're trying to start some exposure right here. I don't think it's something that makes, that you want to be aggressive with just yet. If you think of it in tactical terms, however you want to frame it to yourself. But I think with the reversal today, closing back above 25.85, you have a clear line in the sand. If we start closing below 25.80, all bets are off. Reduce that long exposure. You took your small shot, and now it's time to exit and see what the market has has in front of it. So that is something to think about. Again, I think structurally, I do not think this is the all clear level by any means. I think for me, again, back to the weekly chart, for an all sort of clear level to ramp up some more exposure, I'd really want to see us more above 26.75, reclaiming some of these moving averages and last week's highs on the weekly chart. That is a bigger level, but to start with, for you real tactical, opportunistic traders, I think today gives you something to potentially trade against. I hate the slope of these moving averages, right? So you have to remember that you're going against the grain here. These are bearishly aligned. That means you should expect rallies to sort of fail. You should expect resistance to hold. That is the general sort of disposition or thought process that I personally have when I look at markets that are aligned like this. But again, if you're tactical and you want to make a trade back up to maybe even if it's just a move up to 26.60 or so, that's another 50 handles in the S&P 500. So, again, I think that is a reasonable approach, but structurally, I mean, this chart, again, is still fairly messy here with the declining moving averages on the daily chart. I think you'd have to get above 26.55, hold above that level. That would give you some confidence that maybe the selling is, in fact, done. So if and until that happens, I do think you want to keep things at tactical. You want to make sure you have enough cash, mind those position sizes, so on and so forth. 25.85 on the downside, that is the level. That's what I would be paying attention to, or you could cheat down to today's lows around 25.75. But generally speaking, if we start losing this level, all bets are off. I think you need to protect yourself, or at least be aware of the sort of cliff that this market could be hanging on to. So that's generally the gist of the S&P 500. I think that's what I'm looking at here. Very tight right now. Encouraging reversal. It needs follow through. It needs to prove itself, right? There's a lot more work to be done, but I think today was a good start. And if you laid out a little bit of exposure, kind of like we did, we still have a very high cash position, 70% plus, but did put on a long today, have another long on from the other day. So we got a little bit of exposure here in the market, and we know where we're going to exit if we start to unwind today's action and start to break down. So S&P 500, I think that's pretty clear. Russell 2000, Let's go down to our other board here. And again, just take a look at the confluence here of levels where this is reversing. You can see, again, the big washout day yesterday was Monday, 2.44% to the downside. We scroll out, we see this trend line that extends again from the 2016 lows, kind of coming right into this spot here. We got some horizontal levels right around this 150 level. So this general area, again, is the exact place where we want to see this market hold before things get ugly. And so far today, it does look like it's holding its first steps, declining 8 and 20 period moving averages. We're not out of the woods yet, but it's something to at least hang a little bit of a hat on there. And the NASDAQ 100, again, you can see that yellow line again is where that bigger trend line comes in. You can see we are still sort of below it, but we're trying to reclaim this 156.60 level. We are still above the February lows here, and again, still looks vulnerable, but a little bit of a reversal and a start here to maybe test the waters with some light longs, but everybody again is going to be very different on that. One other aspect here that I want to talk about really quick is market internals. Two metrics here: advanced decline line on the NYSE, so that's the top pane that you're looking at right here. This is the cumulative NYSE AD line, and you can see here that while price is, so go down to the second, the second level down here, NYA. This is the NYSE. This is the composite stock index here, and you can see while price is back to, or actually even slightly underneath. No, it did reclaim the February lows. We can see it briefly undercut the February lows here, the NYSE Composite Index. Back to the top pane, the AD line is actually making a higher low. That is a bullish, sort of bullish, what we'd consider bullish divergence here in breadth in the NYSE AD line. That is encouraging. It is not a standalone buy everything signal, but it is encouraging, which again may give you that extra confidence to say, you know what, yes, we are bouncing at a very critical level here in the S&P 500. We do have some breadth divergence here to the upside. That is encouraging. The price action is slightly encouraging in the short term. Maybe I'll put on some exposure. When we look down here at the number of stocks making new 52-week lows and highs, so the highs are the green, this green graph here, and then the lows are the red. You can see we are still making more net new 52-week lows here. Just take a look here. Made 133 new lows today. Only made 16 new highs. I don't know if that number has been updated. Actually, that's April 2nd, so that looks like yesterday still. So this isn't today's data. You can see there is still more new lows being made, but take a look, there's a lot less new lows than what was made in early February, right? So look back here in early February, we had 450 52-week lows made on February 6th. You can see we're only making about 100 or so now, in recent trading. So again, it's not the most encouraging, but it is slightly better. There is a slight improvement on a relative basis to where we were back in early February to where we are now. So that is something to think about, chew on, and put in the back of your mind when it comes to market internals. So hopefully that gives you some good levels and things to think about, scenarios to map out in your head. Overall, again, let me just reiterate, I do think caution is still advised. I think if you're tactical, you can potentially play on this bounce here for today, but make sure you know where your exit is. Make sure you have that experience in place, position sizing, and all that good stuff that you need to think about. So that's the overall market environment. Let's get through some other major markets here. We got TLT, which came crashing down today, 77 basis points. I use that term very lightly, crashing down, just essentially retraced the past several days of action, coming back into this 8-day rising or flattening at this point exponential moving average. We got stopped out of our trade here today. We were playing this via TMF, the 3X ETF. We got long right here. We sold into this level around here, 122 or so. We were looking for a second target up closer to around 123. That did not happen, and we got stopped out on the rest for a small gain. So overall, a very small win on that position, but I will take it, and we'll see what happens here heading into the end of the week. Gold is next. Gold, you can see down 75 bips. Had a strong day yesterday, up 1.17, and then gave back 75 basis points today. So kind of all over the place, still indecisive, still moving, kind of these knee-jerk 1% moves up and down. You can see overall, though, this longer-term consolidation is still just very, very much intact, and it's something that just needs more time. In fact, frankly, this could move sideways for another couple of weeks inside the same exact pattern before we get a more definitive breakout. I still like the overall larger term structure and posture here in gold, but right now on this daily time frame just looks like a headache. Doesn't seem like there's too much to do at this point. Silver, kind of the same thing, had this nice pop yesterday, gave most of it back today, still moving sideways in this horizontal channel here. So really not much else to say about it until it starts breaking below 15.25 or back above 15.90 or so. Looks like it's just really consolidating. And then finally, commodities. USO still kind of pulling back here after a nice run up in throughout the second half of March, and you can see it's back to testing this 20-period EMA. Let's see if the bulls can put in a higher low here. That would be encouraging, and then really, you get this breakout level around 13.28, 13.25 to the upside. So if you're looking for a higher low to come in here, you could be playing for that, or you could just be waiting for this breakout play. Otherwise, sit tight and see which way this ends up resolving itself. And then finally, natural gas kind of going sleepy again here, quietly moving sideways. 8 and 20 period, pretty sideways. They are still above price. Volume's kind of drying up here. So we need to see a little more excitement out of this. I think to the upside, 22.75 or so. That's what's going to get natural gas excited here and some momentum back into this market. So that's what I'm waiting for. I'd potentially be looking for a long trade if we can start to break above 22.70. Until it does, until we see that strength proven, really not going to be too interested in touching this. If anything, sellers might have the ball in their court if we start losing about $22 or so in the UNG ETF. So that, I think, covers everything that I wanted to for this midweek video. Thanks again for watching Tuesday and Friday, and hopefully you're doing well out there. So I will talk to you again on Friday. Thanks so much, and talk to you soon.